Manish, you can start whenever you
Yeah,
feel
yeah,
like it. We
yeah. You
are
can.
also live on YouTube now. Okay.
Okay.
So,
Thank you, Jayada. Thank you so much.
okay.
Good afternoon, everyone. I'm Manish Lamba. I'm director and part of Nat Health team. We welcome you all to our Nat Health Expert Speak series. Today, we are joined by our esteemed panelists to discuss very critical and vital topic of decoding drivers of hospital valuation and pathways to funding for healthcare. The panel members will discuss and share their valuable insight on various aspects of valuation and funding, which we all know are driven by multiple factors, both internal and external to a company. The session will also throw light some factors how they affect our impact our investments and valuation. Also, for the viewers, for the participant, we are broadcasting this expert session live on our YouTube handle, Nat Health India. We welcome all the participants joining us live on YouTube. For participants, we have allocated a dedicated time for question and answer session. During the end of the session, we will reach out to you for any questions. We also encourage our participant joining us live can post their questions in the comment section. So now, without taking much of a time, I would like to formally introduce our panelist. I would like to introduce Mr. Ratan Jalan, founder and managing director of Medium Healthcare Consulting. He is also the moderator of our session today. Mr. Jalal is widely regarded as a thought leader in the healthcare industry. It was his strong urge to make a difference in healthcare that led him to set up Medium Healthcare Consulting, an end-to-end healthcare consulting firm based in Mumbai. Mr. Jalan plays a very important role in shaping Medium's policy, with particularly thrust on innovation, execution, and patient centricity. For almost a decade, Mr. Jalan was the CEO of Apollo Health and Lifestyle, part of Apollo Hospital Group's India's largest healthcare provider, with 10,000 plus bed and with a revenue of $2 billion. He also created most successful innovative healthcare formats in the country, the network of Apollo Clinic, a chain of 100 plus urban clinics, and the Cradle, the South Asia's first boutique birthing center. He started his professional career in information technology industry with HCL and then moved to advertising at Lintas. He studied engineering at Indian Institute of Technology, the premier institute in India. He also went to study general management at Harvard Business School and then completed an executive education program on innovative healthcare leadership from Stanford Graduate School of Business. He is a visiting faculty to a lot of leading business schools in India, a frequent speaker at various industry forums, such as World Economic Forum. He was also one of the few panelists invited from India to speak at Harvard Business School's Global Senatorial Summit. So thank you, Mr. Jalan, for joining us. I would also introduce our second panelist, Nitish Agarwal, founder and managing director, Indium Capital. Nitish founded Indium Capital in 2014, focusing on mid-market segment with a transaction size of 20 million to 500 million across healthcare, digital, tech, and consumer. The Indium team has a rich experience of 50 plus transaction with a cumulative value of over $1 billion. With Nitish's 20 years of plus leadership experience with Indium, Allegro Capital, GE Capital, and Genpact. Nitish and his team has an extensive experience in advising client on equity fundraising as well as domestic and cross-border M&A transaction across sectors. Nitish is a mechanical engineer from IIT BHU and MBA from IIM Calcutta. Thank you, Nitish, for joining us today. I would introduce Kritika Sivaraman. She is the Senior Vice President at Indium Capital. She is heading the digital and tech vertical at Indium. She has 50 plus years of experience in investment banking and corporate strategy. Her past experience include Photo Infotech and Allegro Capital. She is an electrical engineer from Anna University and MBA from IIM Calcutta. Welcome, Kritika, for this expert session. Now, I would request Mr. Jalan to take this discussion forward.
So thank you so much, Manish, for such kind introductions, if I may say, and welcome all the participants. Uh, the subject, I think, is very relevant, and largely because in the Indian context, when we talk about healthcare, and if you look at the size of opportunity in the sense that what is existing as a solution and what needs to be done, there is such an enormous gap. And we talk about different kind of services, geographies, payer groups, etc., etc. Now, that being so, if the capacity needs to expand, then obviously it requires enormous amount of capital. And to that extent, I think the subject is very crucial. We are talking about valuation. We are also talking about how do players in healthcare sector, how can they expect to get funded. So I think they're very important subject, and we couldn't have found better speakers, better panelists than, let's say, Nitish and Kritika, who have done it. Okay, I mean, who have lived the subject, done it, been through several, let's say, successes and some challenges and failures. I think to that extent they're going to talk from their experience, and the way we thought they will structure the panel discussion is that I would request Nitish to kind of share some broad concepts and some broad numbers, if I may say. Okay, and he has a presentation to share to at least set the context for that matter. And post that we had received some questions. So I would pose some of those questions to Nitish and Kritika, and then there could be questions which are thrown to us, okay, during the panel discussion itself, and we'll try to select at least a few questions, and before we end the discussion, have those questions also addressed. So thank you so much, and Nitish, um, uh, over to you.
Thanks, uh, thank you, Mr. Jalan. Thanks, Manish and the NatHealth team for organizing this. Very good afternoon to all the participants, and thanks for joining in. Um, Between Manish and Mr. Jalan, they've already spoken a bit about us and me, so I won't spend time on that. I would just say that while we are practitioners of valuation and we do mergers, acquisition, and fundraising in our firm, and most of our work, a large part of our work is healthcare. Um, we must never forget in the context of today's discussion that value is created, and valuation of any enterprise is created by what you do within that enterprise, right? So whatever efforts you put in, whatever strategy you follow, whatever execution you do, whatever steps you take, make or break the valuation. And it's not the other way around. Valuation is not done from an outside external point of view. It's a very intrinsic thing to what people running that organization are building. And number two, while all of us try and put some framework, some formats, some methods and mechanisms to create valuation, we've got to keep in mind that there are always multiple factors at play, and the interplay within those factors differs a lot. So all valuation exercises are at the end of the day judgmental, and a lot of that judgment is based on experience. So it's never A plus B is equal to C. We do end up finding a lot of people who understand that very well. And there are a lot of people who just say, hey, I other companies valued at X multiple, so I should also get X. It's not as simple as that. There are multiple factors. We'll attempt to look at some of them. Lastly, before I jump in, 1 hour or so is an extremely short period of time. So I would request the participants to bear with us, because we will be probably just touching the surface of some of those topics. Anything that is not covered, we are happy to take questions later, but we'll try and address as many as possible. So I'll just jump in with that. I don't know who that was, but I guess that was somebody not on mute. I'll just jump ahead. I'm going to share a presentation, and I hope that everybody's going to be able to see it. Can everybody see this now?
Yes, Nitish.
Okay, wonderful. So this is what we're trying to discuss today, which is valuation drivers and pathways for funding for healthcare companies. So we thought we'd share some information or some perspectives on the following, and I'd welcome Mr. Jalan and Kritika to jump in as well, with their thoughts. Mr. Jalan, like I said, is a healthcare expert. His views on how to make healthcare companies run better are what actually drive valuation at the end of the day. So I look forward to his views as well. So we'll look at methods of valuation. What are the broad methods that one follows for valuing healthcare enterprises? What are the drivers of those valuation within the healthcare companies? Then what are the valuation trends and multiples of a large number of listed hospital companies now? What are the such similar trends in private hospital companies? And a question that's been asked: what are the possible avenues of funding for healthcare enterprises? So we're going to cover that. Let me just quickly jump into methods of valuation. Again, we've tried to keep it very simple. Like I said, please keep in mind that these are very, very simplistic frameworks that you're putting it up here. So if you see, there are three broad methods of valuation. There are three rows there: replacement value, multiples, and discounted cash flow. The way this is the way hospital healthcare valuations are done, and it's similar to other industries as well, is that multiples, one in the center, is what is almost always talked about in terms of what's the multiple of Apollo, what's the multiple of Max, what's the multiple of my next door neighbor who sold his or her hospital enterprise, and how does that compare to me? On above that is replacement value, and below that is discounted cash flow. Now, let me get discounted cash flow out of the way. A lot of people tend to use DCF. They tend to apply to hospitals, but it's the least used or least relevant valuation multiples in the context of healthcare enterprises, because its applicability is only for mature stage businesses. Fundamentally, the way it is made. And most hospital enterprises in India are never at a mature stage. All of them are almost all of them are growing. Even the large ones are still growing. And so you have a lot of volatility in the cash flows and discounted cash flow for that reason. I'm not going to get into the details of volatility and discount rates and terminal value and all, but it lends to very, very volatile outcomes of valuation. It's the least used by anybody who's looking to do any transaction in healthcare. Replace multiple, like I said, is most widely used, but the one at the top, replacement value, is also often used, but its applicability is for earlier stage companies which are just started off. Let me take an example of a hospital. A hospital that has been built recently has not yet reached mature occupancy and therefore revenue and EBITDA. Now, you obviously cannot value them on multiple of EBITDA or multiple of revenue, etc. So you kind of tend to look at what would it cost somebody to build that hospital. And in that, the components are very simple. What are your investments made in land, building, and equipment? Those are the obvious ones. But what is typically takes a lot of time to figure out is point B in replacement value, which is what is the premium for the time and opportunity that it takes to build that hospital. In the Indian context, there is a lot of time that you get to build healthcare companies and enterprises, and there's an opportunity cost as well. Even if you had 200 crores with you, you may not be able to buy a piece of land of 3-4 acres in the middle of a large city in India. It may just not be available. That opportunity may not be available. So there's some premium for that. And you use it when hospitals are still at an early stage or other healthcare companies at an early stage. When you are somewhere in the middle of a totally mature hospital and an early stage, which is where a large number of hospital enterprises are in India, you tend to use multiples. That's the center line. Three multiples put there: EV to revenue, EV to EBITDA, and EV to bed. Most often uses EV to EBITDA. Then followed by EV to bed, and then followed by EV to revenue. So EV to revenue, this is my revenue. What is the multiple of that to calculate my enterprise value, i.e. my valuation? It's the least used. A lot of people use that, but it's really not the one to use that. EV to EBITDA and EV to bed are the two more relevant ones. The way it works is as follows. I have a 100-bed hospital. Another person has a 100-bed hospital. Out of that 100 beds, I'm getting 20 crores of EBITDA. The other person is getting 15 crores of EBITDA. My valuation is 200. So on 20 crores of EBITDA, my multiple is 10. 20 crores of EBITDA into 10, 200. So I say for the other hospital, which is getting 15 crores of EBITDA, I can apply the same multiple of 10 because it's very comparable. So I'll get a valuation of 150 crores because their EBITDA is 15. On the other hand, I might say that my EV to bed is 2 crores a bed, 200 crores of valuation, 100 beds. And if I apply it to the other hospital, you have 100 beds as well. And if I multiply by 2 crores per bed of enterprise value, it also get to 200. Now you see in this very simple example that there can be differences in the way multiples give outputs. So you got to apply more logic in terms of what is the normalized EBITDA, what is the upside and stuff like that. But these are the two more often used benchmarks for valuation in hospitals. But I must say, they're not straight-jacketed. You can't just say EBITDA and put a multiple. You got to look at the most important thing in multiples is comparable multiples. What a lot of people miss is multiple-based valuation is a comparable multiple-based valuation. So an example that I took, if hospital A is exactly like hospital B in a lot of parameters, which we'll discuss, then it is comparable, and I will use the EBITDA multiple and apply the same thing.
but it may not be comparable on many factors. So I might have to use EBITDA per bed because it's not as mature as the other hospital. So, et cetera, et cetera. So let me sum up this. In the interest of time, I'll move on. Valuation multiples are the most often used valuation. Within that methods of valuation, within that EV to EBITDA followed by EV to bed are the most often used. Less often used is replacement value or applicabilities in early stage. A discounted cash flow, almost never. We've never seen once any serious transaction happen on the basis of DCF, although some people may calculate it. So I'll move on from here and come to drivers of valuation. What really drives valuation for hospitals? I'm going to just come to this slide and see. If you see, there is 3 columns, if you will: inputs, operating financial outcomes, and valuations. I'm going to just spend a minute on each one of those 3. So if you see on the left, there are many input parameters that are there. There is setup and infrastructure, there is quality of operation, there are some external factors which go into running a hospital. Right now, these are nothing new. These are things that hospital owners and operators know intrinsically, and they deal with it on a day-to-day basis. But it's good to put it on perspective, because all of these and many more as well are drivers of valuation. They add up. So in infra, what is your location? What's your catchment? That's very important, because that itself defines what kind of business you can do in that area. The size of land and building, you'll be surprised how much the size of the facility can affect the pricing and other parameters, which can lead to how much financial and operating outcomes you can derive from that building. Of course, quality of infra and the number and types of beds. Let me give a simple example on type of beds. You could have a hospital with 200 beds and only 50 beds in single or double rooms, and 150 beds between casualty and wards. Another 200-bed hospital with just, let's say, 50 ICUs and casualty and no wards, and 150 beds in single or double room. Now, obviously, the latter one would probably have a higher ability to do revenues and outcomes and would lead to higher valuations. Then quality of operations, obvious things like pricing, doctor engagement, the quality of that, what specialties you focus on, what is the brand recall these days as compared to 15, 20 years ago. The hospital brand is increasingly becoming important, not just the doctor's name. The quality of medical outcomes, it's a fuzzy one, but it's an extremely important one, because over a period of time, patients do figure out which are more reliable hospitals to go to, and they get visited, and they end up having higher operating outcomes. And obviously, there are external factors like market potential, regulations come in a way once in a while, competition in the micro market. Now, all of this results in some operating and financial outcomes. All hospital operators are very, very familiar with these numbers, but they are outcomes of what you do on the left-hand side. So, your RPOB, which is an indicator of pricing ability, your revenues, your margins, your cash flow. How did you capitalize the setup of the hospital in terms of debt, equity, etc. So not just your operating cash flow that you make from running the hospital, but how does your financial cash flows and how are they affecting your overall money in, money out. Obvious ones like occupancy, the growth rates that you can get not just in the past but in the future. How much headroom do you have available to grow, maybe build new infrastructure next to the current one, cost structure, ALOS, diversity of revenue and specialty, the investments and already made into the hospital, which can derive benefits in the future, or the opposite of that, how much investments you need to make to continue or to bring the hospital up to, let's say, competition in the area and capital structure. Now, all of these things, okay, the sum total of all of this will affect applicable multiples, valuation, and therefore investor interest, right? Now, I'm aware of the fact that this is a very, very simplistic view of the whole thing, but you must keep in mind that these probably are 70-80% of the factors that affect valuation. And there's no surprise. These are what most hospital operators already know and do on a day-to-day basis. So I reiterate that what owners, operators, management do within the company is what results in good valuation or not so good valuation, and terrific operating and financial outcomes, which are the result of terrific inputs that you put into the business, result in that. Now, that was for hospital. We're going to focus on hospitals because of shortage of time, but I just wanted to touch upon, if you see on the left column, there's some such factors for diagnostic centers and some for single specialty. Now, clearly, they differ from hospitals. If you see diagnostic centers, location, the focus, whether it's path or radiology, the quality of equipment, your collection points, logistics, your ability to collect samples, number of doctor partnerships, your pricing cost structure, obviously, your marketing and advertising spends. Those are the kind of things that become much more important than in a hospital. So they are unique to diagnostic center. Single specialty, similarly, there are other things. Unfortunately, because of paucity of time, we'll not focus on that. We'll keep it on hospitals. Just wanted to give a flavor to everybody, saying that valuation drivers can differ between hospital, diagnostic center, single specialty, devices, what have you. They are different for every such format of healthcare delivery. I'm going to hand it over for the next couple of sections to Kritika to take us through valuation trends and multiples in hospitals. Kritika, over to you. Kritika, we can't hear you. Sure. Is Kritika on the call, Manish? I'm not. Manish, is Kritika here on the call? Can she hear us? Manish, you are also on mute. Okay. Hey, Manish, Kritika is just pinging me saying she's not able to unmute. Can you guys do it from your side?
Hi, can everybody hear me now?
Yeah.
Perfect. Okay, so that was that was a bit amusing for a bit, but so hi everyone. Just after that short weird break, I'm just gonna take on from where Nitish left off. Just give me a second. I'll share my screen. Well, I hope you all can see the slides. I hope the slides are visible to everyone. Yep. Fair enough. I'll just go ahead. So after Nitish's input, I think so we spent the last couple of sections, if you will, on just explaining what are the building blocks of valuation, if you will. I'm just going to spend the next couple of sections talking about what are the kind of trends in the market right now. Very quickly, it is how valuations of listed hospitals have trended in the last couple of years. As you can see, they have been growing and growing faster than the Sensex in the last couple of years. Many reasons for this, because healthcare sector in general has been growing significantly. Just for example, in the last 3 to 4 years, the number of listed hospitals we're tracking have pretty much doubled. Amongst many other reasons, we've had a lot of, I'm going to say, addition to this valuation benchmarks in the basis. I'm just going to go ahead. So that was just what the valuation is, right, in terms of market cap. What that means in terms of valuation multiples, which Nitish pointed out earlier in this discussion, is that so there are two broad types of multiples people look at, right? There is EV to EBITDA, and then there is EV to BED. If you see the blue lines here, which is there in the middle, that's the overall average multiple for all of these 15 listed hospitals that have been there over the last 8 quarters, right? That's as you can see in the current latest Q1 kind of numbers, it's about 28x on an EV to EBITDA basis and about 7x on an 7 crores per bed on an EV to bed basis. However, as just taking on from the previous section that Nitish was talking about, which is that what you do internally kind of impacts your own financial outcomes, which impacts the multiple that would be used to value you. For example, RPOB, just as an example here. RPOB obviously is driven by how you set up your hospital in terms of its positioning, in terms of the specialties you do, in terms of the kind of mix of procedures you do, and so on and so forth. Of all the 15 hospitals, if we just split them into two sections, one which is like a high RPOB group, which is those who have a revenue per bed per day of somewhere like 60 to 80,000 rupees per day, right? To a mid RPOB group, which is closer to, let's say, 30 to 50,000 rupees per bed per day, right? The variation in EV to EBITDA multiple is 20% up or low compared to what is the overall average. So, for instance, if the overall average EV to EBITDA multiple is 28x for everyone, the likes of an Apollo, a Max, and a Fortis, all of them who are in the higher end, are actually trading at a 34 times EV to EBITDA multiple. And those who are at the mid end, the likes of KIMS Hyderabad or Narayana Hridayalaya or or a Shalby and so on, again, there's many of them, are at the slightly lower at a 23x on an average, right? As on the bed side, if you notice this variation is a lot more stark. It's about 50% broadly plus or minus, depending on whether you're a high ARPOB or a low ARPOB hospital. Consequently, again, what we're just trying to explain from the slide is many factors impact what multiple is used to value you. One of which is ARPOB, and you can see how that affects, if you will, how you value hospitals, right? Again, now all of this was about listed companies and listed hospitals. Mostly, we would not need to get help to value listed hospitals because that's defined by the market because it's traded there, right? Where it is uncertain is the private segment where there is no active like listing or trading that's happening on a day-to-day basis, right? So on the private side, just to give you an example of how the multiple changes. Now, if you were to take the listed hospitals, and you can see here, we've just grouped the high RPOB and the mid RPOB hospitals here on the left. And we saw that their EV EBITDA was 34x and 23x. We just saw that in the previous slide. Right? If we try to equate them to a private company, which is that we apply relevant discounts for listing and growth rates of companies, right? The 34x would be equivalent to a 24x for a private company of a similar scale, right? Or a 23x would be equivalent to 16x for a private company of a similar scale. When I say similar scale, because all of these are large chains, right? They have thousands of beds, multiple locations, and so on. So equivalent private multiples for a company which is broadly the size of, let's say, a Fortis, a Medanta, or a Rainbow in that broad RPOB group would probably be 24x, while the listed guys are at 34x. That's the difference that happens from a private perspective. Just to corroborate that, we'll just show you a quick example of, let's say, there have been, we all know, there have been many transactions that have happened in the private space in the last couple of years, right? And if you see this, the large chains have all on an average been at 18x on an EV to EBITDA basis, right? Which are large chains, which are broadly therefore similar to the listed hospitals that we just saw in the previous slide. And the small chains, which are, let's say, 1,000 beds or less, on an average have been in the, I'm going to say 8 to 12x, but broadly like if you see 11x on a median basis, right? So that's really how I'm going to say private multiples vary from a listed multiple. Just quick, I'm going to say thumb rule numbers to keep in mind. Just going ahead. So the last section we wanted to.
If I jump in on the previous slide. So folks, there's a lot of data here. We don't need to go through each line item, but if you notice, there is a wide variation in the multiple of each hospital. And what is mentioned in red is just the median number. So what we end up doing a lot of times is we just take the median number and we say that this is the multiple for hospital, right? Now that is not correct because each hospital, if you see, they actually have very different multiples and they're higher or lower than the median. So in a sense, it comes back to what we started off with. Every company is different. You've got to go and say, hey, why should a multiple apply to me? Am I better than the average and therefore should I be valued higher? Or unfortunately, I'm not better than the average and so I should be at a lower number, right? So that is something that we have to always keep in mind. We see a lot of time people just take data like this somewhere, they just pick up one data and say, I should be valued like that. In fact, if we go back to slide 14, I wanted to show this point there. When Kritika had mentioned about a multiple for high ARPOB hospital being 24x effectively and a mid ARPOB being 16x, please keep in mind that this is not yet adjusted for size, which is, if you see at the bottom, it says these are the multiple for similar sized hospitals, i.e., if you look at any of the mid ARPOB hospitals, Narayana, KIMS, Asta, HCG, Kowai, which are very high ARPOB, 40,000 ARPOB is a pretty high one. And if you are as big as them, you could probably command a 16 times multiple. Now, in reality, if you're a private hospital, chances are that you will not be as large as them. So somebody would say, I would attribute a higher multiple to a larger chain and a lower one to a lower chain because economies of scale, your ability to have a presence in the market is significantly improved in healthcare hospital business as you grow larger. So chances are that when you look at different size hospitals, the multiple will be different. So if you look at this slide and the next, you will see that there is a huge variation in multiples and it is affected by many of the factors we discussed earlier. Back to you, Vipin.
So just one question, Nitish, I thought maybe relevant for the people here, that if you go back to the earlier slide, and if you're saying that there is data for listed companies, let's say, which I would assume represents a fair valuation, which is 23 or 34 multiple, why is it that when you talk about deals in the private, let's say, unlisted domain, the multiples have to be necessarily so much lower?
So the largest contributing factor to that is captured in this slide at the bottom, which is, when you buy shares of a listed company versus a private one, this is across the board, people would pay a premium for the listed company shares because you can buy and sell them anytime, right? So that's called liquidity. So if you apply the opposite of that to a private company versus a listed, you will look at a discount for listing. So the 34x is going to 24 for that one reason. Secondly, all of these multiples are looking at your performance in the last trailing 12 months. Whereas if you are if you're looking at valuing a hospital today sitting in November, you would typically be looking at this year's data. So it's adjusted for those two factors, Mr. Jalan. And the third big factor is typically size. That's what I said. If you were as big as Apollo, you would get a 24x multiple, but chances are you are not going to be as big as Apollo. So you would get a discount on that multiple.
So the third thing that I would like to add as well which is similar to the next slide information is that one is, whether it is easily tradable, like Nitish said or not, but consequently, because there are limited owners or limited buyers and sellers in a list private hospital chain, it also therefore depends on the motivations of the various buyers and sellers and their interest levels and so on. So that's why every deal is different. Even though a transaction may have the same number of beds and the same revenue and EBITDA, it may not get the same multiple because of various reasons, including the stakeholders in the process of that transaction.
I get that. Thank you.
Should I go ahead?
Yeah, please.
So there is only one last thing that we wanted to cover in terms of a presentation, and I know the presentation has taken a significant amount of time in the discussion itself, which is, at a high level, what are the avenues of funding that people have? And again, we're talking about private players here, right? Obviously, listed players have multiple more avenues of funding, including raising more from the market. Right. So at a very, if you see here, it's talking about 4 different types of things, but it's essentially debt and there is equity, right? We all know that. There is debt, which is loans you may take from banks or NBFCs. There is equity you can raise from, individuals and, doctors and, friends and family and so on, which is the second column. There's a third column, which is equity that we would have heard a lot about, a lot of transactions, which is the larger sized equity that you raise from institutional funding. Right. And then there is the fourth group, which is when you divest a majority stake in your company for money into the company, for some exit, for more monetary value unlocking for shareholders, or so on. So there's broadly like 4 different types, and these will become applicable to you depending on the kind of stage you are in, right? So starting from debt. So when you start a hospital, and again, a lot of you would have already experienced this, when you start a hospital, you can fund it. You typically fund it with equity plus debt, a large amount of debt, because you're building assets and you can mortgage that with banks and they'll give you moratoriums and you can spend that. So it's typically an early stage kind of a funding requirement. That's funding avenue, which is debt from banks, right? Or whenever you're doing a massive expansion or so on. Again, when you raise bank money from banks and NBFCs in this stage, they do require 2 things. They expect you to also contribute some equity to come in, because they're not going to fund the entire project. So the criteria number 1 is that, and the criteria 2 being you need to obviously have assets which are either being built as part of the hospital or some sort of personal guarantee collateral, which typically all banks end up asking the promoters of the hospital today. Right. So there's debt, but obviously that cannot completely fulfill the requirement for funding hospitals. In early stages of a hospital, the only other avenue you typically have is equity from individuals, doctors, HNIs, friends, and family, which is multiple or few individuals can put in some minority of the money required to fund your hospital, so that you get the overall funding tied up with that plus the debt, and then you're able to set up the hospital, and then you perhaps move to the growth stage over the next 3, 4, 5 years. Right. So the first 2 are more on the early side. The third one, which is equity from private equity funds. Now, while in the last few years and across many, we've been seeing that private equity funds like to come in when there is lower risk, if you will, of a venture growing or not. So now we're talking about minority equity, i.e. when you raise money from a fund, they come in as a minority investor, and you're the one who is continuing to build, run, and grow the hospital as a majority owner of the entity. So in this case, you typically need to have at least 1 to 2 or more hospitals which are running and are profitable, right, at an operating level. Like you need to be generating positive EBITDA and working capital and operating cash flow, right? Such that they are then coming in to say that how do we expand the 2-center or 3-center chain to 4 or 5 over the next 5 years. So that's typically when you get private equity fund interest in a hospital chain. And then there is the last option here, which we've seen a lot of in the recent past, even and more increasingly more so in the last few years, which is when private equity funds come in and say that we are buyout funds, we set up platforms, we will acquire the entire entity, and then we will sort of build and put more money and expand it ourselves, and then maybe it'll become a large chain and then it'll list. Right, and we've seen the likes of the KKRs, the TPGs, the Blackstones of the world sort of come in and be in the news for reasons like this. The other kind of people that do majority acquisitions are obviously strategics themselves. Strategics being an existing hospital acquiring a new hospital. So in this case, therefore, this acquisition type of play can happen in any stage of a hospital's journey. So in case of a early stage hospital, which for whatever reason the promoters have decided that they do not want to sort of go ahead with it and would rather unlock value and try and do something else, they could possibly look for buyers. A hospital in its growth stage, which is doing well and growing, could also have appropriate buyers or acquiring with the funds or platforms, right? And even in the late stage, there could be a merger of 2 large entities sort of coming together and becoming even larger and going on. So this can happen in any particular stage. Again, as you know, if it's a majority, say, divestment, it becomes a sale to a large extent. Of course, there are variations. All of these things have variations, right? But essentially, you're giving up majority control of your entity or asset for value unlocking to yourselves as shareholders, as individuals, which you can then reinvest in whatever you feel like going forward. But broadly, these are the kind of funding options that hospital entities have and have seen in the last years.
I'm just going to only add that for hospitals in India, hospitals obviously are very capex intensive, land, building, and equipment. Each of those three cost a lot, and the cash flow from hospitals starts to generate maybe as late as fourth, fifth, sixth year, right? To pay off your operating costs as well as your debt related payments. So it's like a long cycle capex, almost, I would not say exactly, but almost akin to infrastructure projects. So electricity, for example, is a 30-year project. This may not be 30 years, but certainly is a 10, 12, 15-year project. Unfortunately, there is limited avenues of funding available like an infrastructure project for a hospital. That's why many entrepreneurs who set up hospitals are forced to look at the what Kritika was talking about, the HNI, friends and family, or their own capital, or a lot of doctors come together to pool in money to set up these hospitals. There is very few avenues available in terms of either private equity or even debt to build hospital early on. You can get debt, but then you need to provide, all banks will ask for some external collateral for you to get there. So that's a hard reality. But that is how we've seen many entrepreneurs, a large part of them doctors, set up large multi-specialty hospitals. It's relatively easier if you come to single specialty formats or clinic-based formats, because the upfront capex is lesser. So if you were to set up a mother and child center, you probably spend 15, 20, 30 crores, something in that range. If you were to set up an IVF center, you spend about 5 to 8 crores, right? If you were to set up, something else, it might be even lesser in the clinic format. So the quantum is lesser. And the returns from that cash flow are faster. But hospitals, multi-specialty hospitals, are the most difficult bridge to cross in that sense.
I mean, the only thing I'll add here is of late, we're also seeing development finance institutions coming in and, giving longer term capital, but that's also typically to growth stage kind of hospital entities rather than those which are in their first or early stages of operation.
So thank you. Yes.
Please, Mr. Zan, please go ahead. Please.
Yeah. So thank you, Nitish and Kritika. So there were a few questions which we had received from participants even while registering. So I'll pose a few of them, and there are a few questions which we have got, and we'll probably get a little more during the session itself. So to begin with, one of the questions was that how does one value a fairly new but growing hospital? So I'm just saying, because a vast majority of them would be in that stage. So there is a hospital, maybe one hospital, 150 or 200 bed, which is doing reasonably well. And if the promoters were to think of growth, then what are the possibility and how does one value such a hospital?
Kritika, you want to take?
So, why don't we start with this? I'll just one second.
Oh, okay. So let me just put the slide back that we were looking at earlier, and I'll answer it in that context. Kritika can come back as she needs to get a glass of water. So if you remember, we talked about replacement value earlier on this methods of valuation. So, Mr. Jalan, the question that you asked is largely, that question is answered by the replacement value method. So hospital which is early on, which has just been set up, let's say a year ago, probably has 30% occupancy, 20% occupancy, 40% occupancy, a very high fixed cost. So, at 20, 30, 40% occupancy is far off from its, potential of revenue. And because fixed costs are high, it's probably making little or, even negative EBITDA, right? Or maybe some positive EBITDA, but not much. So it's very difficult to use EV to EBITDA and EV to revenue, to value such hospitals. Any incoming person who's evaluating that hospital would not value it on EV to bed, because they'll say, hey, you know what, I can I'll apply the build versus buy framework, saying, can I build this, and what does it cost me to do? So it really boils down to replacement value, but with two components. So one is investments made, which is how much did you spend for land, building, and equipment. But more importantly, for the seller, they have put in a lot of time, effort, and they have captured that opportunity which may not be available to anybody else, right? So whether it's the large Apollo hospital in Chennai, whether it's a large Manipal hospital in the center of Bangalore, whether it is Medanta in Gurgaon or the Apollo, in South Delhi, many such examples. Even if you had all the money in the world, you could not set up a hospital there. That opportunity is gone, right? So there's an opportunity cost. So you have to
Right.
therefore arrive at a premium for those and add it up to and arrive at the valuation.
Right.
So it's
So I get that. So Nitish, I think I'll just add one more line here. That suppose that single hospital which we are talking about were decently EBITDA positive. So I'm just saying there is a performance to talk about. Unlike the earlier situation,
Sure.
would
Sure.
things change significantly there?
Actually, that's a very good point, Mr. Jalan. In that case, you could use a kind of a hybrid approach of multiples. You could say, fine, we are sitting in financial year 24-25. So can I project their revenue and EBITDA for financial year 26 or financial year 27? Apply the comparable multiple and then discount it by 2 years, because that's 2 years ahead. So you could use that hybrid approach of multiples as well. In reality, you end up doing this hybrid approach and replacement value and looking at the results to arrive at what the right number may be. But you are absolutely right. You could use a hybrid forward-looking multiple approach as well.
You could also, just to add to that, in the replacement value method, if it was already a profitable entity, which is to a certain level decently profitable, you would also add higher premium, therefore, because premium is around the losses that you're funding, but also about the journey that you have gone through to become more profitable.
Correct.
Now, and would the valuation scenario, how did it change, like you said, from asset heavy to asset light? So I'm just saying, let's say, even if you talk about multi-specialty hospitals, there could be a situation where one is, instead of buying land and building the hospital, one would rather lease compared to somebody owning it. Now, how does that change the valuation scenario?
I think I want to talk about that.
So it actually depends a lot on the type of interest that we're looking at. So now the purpose of the valuation is to, let's say, sell or divest your hospital to somebody else. Then it depends on what the buyer's view on whether you own the land or lease the land are, because as we know, Mr. Jalan and everyone else, that the larger hospital chains prefer to own the land because they don't want to deal with leases and owners and having to renegotiate over time and so on and so forth. So they would attribute perhaps much lower value, or there would be lower interest if that is the kind of transaction for which we are valuing the hospital. But as an instance, for example, if this was a low capex chain, they have set up a few centers, they're looking to raise funds and grow, and this is a model that they feel is doing well and better. A private equity investor may look at that and say, okay, fine, then should I, because it will automatically, because I'm paying a lease rent, my EBITDA value will automatically be lower by that amount. So it doesn't actually impact my multiple. I can apply the same multiple, but the EBITDA will be lower, and therefore my valuation for that entity would be lower. So just as an example, if the multiple is 12x and my EBITDA is 50 crores and I'm spending 5 crores on or 10 or on lease per year. If I had owned the place, I would have generated 55 crores of EBITDA and my valuation would have been 55 into 12. And because I leased the place, it would end up being like 50 into 12, and that automatically it depresses my valuation to some extent. But it's a variation of that.
Yeah.
And if I get you,
please go ahead. Please go ahead.
Yeah, Nitish.
So I was just going to quickly add, Mr. Jalan, that this asset heavy, asset light question is obviously only relevant to hospitals. because for single specialty diagnostics, etc., most of the facilities are a large portion of the facilities, even for the largest players, are anyway rented. So the reason why it comes into play in hospitals is because hospitals are heavy upfront investment and they constantly need change, upgradation, etc., etc. And so people always have this apply this financial thing saying, should I lease or should I own? Because if I lease the land or the building or both, the return that I have to pay, is lesser if I lease it, right? That's the correct financial interpretation as well. However, it is counterbalanced by the fact, like Kritika said, that it is much more difficult to continue to make changes and upgradation to the building and the premises, which then impacts long-term hospital operations. So there are counterbalancing factors. And we've seen a distinct change in the last 10, 15 years where, contrary to financial logic, the larger chains which have the financial means are increasingly tending towards owning their facility than not owning them.
So exactly. So I think the point you made and Kritika made, I think, which may be worth noting, and like you said, contrary to what financial interpretations may be, the large hospitals have exhibited their love for owning the land and owning the
Yes.
building. Now, whether
Yes.
it makes a lot of financial sense or not, that's a different story. But that's something which has been pretty much hardwired, if I may say, as a behavior. And to that extent, the way they would look at a asset-light model may be very different than, let's say, the way a private equity player would look at it.
Yes.
Okay, and I think if I get you right, and that buyer's perspective is something which is worth accounting for or worth noticing. Would that be fair?
Absolutely right. What also?
Okay. The other question, Nitish, because I would imagine that large players is a different story, but the question is that what would be some of the unique challenges faced by smaller hospital while fundraising, and how could they possibly address them?
Want to make a quick comment and then I'll hand it over to Kritika as well, because the biggest challenge, Mr. Dan, for smaller hospitals, for single, let's say, for hospital versus, let's say, a chain, is that the perceived risk from equity investors. And let me qualify that, because it's obvious to the private equity investors, but not to the hospital operators. So each hospital is a large investment. And if you have one facility, then all your eggs are in that basket, in that micro market, in that location of that city. All right. So you have zero room for error. You make an error, you're going to spend the next 5 years correcting it. And we've seen that happen, Mr. Jalan. You work with so many places where the hospital was half a kilometer away. It would have done much better, but it's simply impossible to change the location, or the way it was set up is a mismatch to that micro market, etc. So the ability to course correct is very, very scanty or very expensive for a single hospital. Obviously, if you have 5 and you've not done a good job with one, you at least have 4 to fall back on. And you display that you have been able to replicate that management skill of setting up successful hospitals over more than one. So that lends to external investors being wary of the investing into the first hospital. And Kritika rightly mentioned, over the last many years, there have been very few instances of private equity funds. There are private investments, but private equity funds investing into single hospital assets. It's always been chains of some kind, whether 2 hospitals or 5 hospitals or 10. Kritika, you want to add something to that?
So absolutely, and therefore also because unlike tech business or whatever, the ones that we see a lot of news around funding in early stage, a hospital setting up multiple hospitals is a very slow journey, like Nitish pointed out, right? So it's a 5-10 year kind of an investment. So it's usually better to perhaps go one, finish one, make that more profitable, and then pay back the debt and then go. It's a very slow game. That's a more organic way of growth until you get to about 2 to 3 might make more sense. And even getting to that 2 to 3 rather than doing one extremely large facility in one place, maybe 200 to 300 bed or so on, or kind of facilities in a cluster might make it slightly easier when you want to go for private equity funding later.
So thank Nitish. I think we have just a couple of minutes more. So I think quickly what we are saying, which is a very, very important point to note, that 300 bed hospitals may be a better bed than 300 bed hospital in a way, because you got a certain chain, you got a certain cluster. That's one. The other question, I think possibly the last question, is that there have been a lot of digital platforms or digital solutions providing healthcare services of different kind. I'm just saying, from chronic care to primary care to oncology, mental health, etc., etc. The question is that how does one go about valuation for such entities?
So the fact that, I'm going to say that it's not exactly, while they are providing healthcare services, the main purpose of these entities, or the main, let's say, core of these entities, is the tech platform and perhaps the scalability of whatever they are providing. And typically it also tends to be a smaller ticket size, and perhaps, like a consultation or like a lab test, or like, that kind of or advice or something online platform, right? So they would not be similar to the way physical infrastructure of hospitals or diagnostic chains and all get valued. People would look at them like any other consumer tech play, right? As long as they see the potential of more users coming in and more revenue getting generated, somebody would rather equate them to a Swiggy. And I'm again saying it at a very, like, just to give a broad analogy, but rather than like equate it to, let's say, Apollo Clinics. I'll put it that way.
I get that. So I think we are pretty much close to the end of the discussion. So I think quick, what Nitish and Kritika mentioned, that when you're talking about solutions which are technology based, then I don't think we have to look at the brick and mortar model. We are talking more about the business model and the growth opportunity. So otherwise, we spoke about how does things get valued and how does the funding happen. And I think we had a pretty fruitful discussion in such a short time. And if there are any follow-up questions, I'm sure you can mail it to Nat Health and they would pass it on to us. But thank you so much. Thanks, Nitish. Thanks, Ritika. Thanks, Manish and the Nat Health team. Thank you all.
Yeah.
Thanks, everyone.
Thank you.
Thank you, Mr.
Thank you
Jalal.
so much. Thank you so much, all. Thank you for joining us. It was really a pleasure. We would like to give a vote of thanks to Nitish, Kritika, and Jalan sir for taking some time out for this session. We would also like to thank, the secretariat team at Nat Health, which supported us to put this session together. Also, would like to thank our communication partner, Health Biz Insight, which helped us to put the meeting put together. Also, we would request, we have made a note of all the questions in the chat box. We'll be reaching out to our experts and try to get some answers, and we'll be sharing with you. Also, last, the recording of this session will be available on YouTube. You can just forward it to your network. You can refer it and write to us for any feedback, any suggestion. So stay tuned for our next upcoming session. We'll keep you posted. Thank you once again, all. Extremely grateful for your participation. Thank you all. Thank you so much.
Thank you.
Thank you.
Thanks, everyone.
Thanks.
Thank you.
Bye-bye.